the cloud. Hello and welcome, everyone. We'll give it a few minutes while everybody joins. Thank you so much for being here this morning. Make sure you grab your water, your coffee, get ready to sit back and engage. All right, welcome everyone. So let's go ahead and get started. All right. So hello, my name is Stevie Gable Carr, and I am so excited to be here with you today. I am on the board of the P&G Alumni Network and also am supporting the enrichment series here today. We have an incredible guest, but before we dive in, I wanted to be able to share with you a little bit about the enrichment series. And so we hope that you'll go ahead and sign up for our entire series moving forward. The enrichment series is monthly, and it's about connecting our members. It's about providing insights and leveraging the expertise of our incredible network. We have, as you know, an incredible 35,000 members in 45 chapters worldwide. We're a nonprofit, but we are officially recognized and supported by Procter & Gamble. We have connections, enrichment, and philanthropy. And we're so excited to be able to gather and connect in November on the 2nd through 5th in Washington, D.C. If you've not been to the conference before, I highly encourage it. I went to Madrid in 2019 and Cincinnati, and I cannot describe the excitement that fills that room when you're with some of your peers and colleagues that maybe you haven't seen in a while, or those that maybe you never had the opportunity to meet. We know as Procter & Gamble alumni that we are special. And I say that boldly because I know that it's true. It's where I grew up in my tenure and really truly look forward to seeing so many of you in DC on November 2nd and 5th. Make sure that you register as our rooms are going very quickly at the Renaissance. So today, just a lay of the land is that we ask that you provide, any questions that you have into the Q&A chat. This is webinar format, so I will be monitoring that as we go through, and as you have any questions that pop up, I ask that you provide them real time, and I will either interject or save them to Q&A at the end. So we've got a few just poll questions that I'd love to ask you. And if you can please participate as we dive in, I would greatly appreciate it. So the first question is, are you a part of a local P&G alumni network? Fantastic. Thank you. I love to see this. And if you are interested in learning more, definitely make sure that you are looking out for any details or information. And I'll also be able to share an email address that we can point you in the right direction at the end of this session. So fantastic. I'm a part of the Cincinnati one, and it's been really wonderful. We have a lot of really great local experiences and ones that we are able to connect with people right in our region. So the second question is, what part of the world do you currently reside in? So I love this question because I love to see where everybody's coming from. Got North America, Asia, Latin America. Wonderful, very well represented this morning and afternoon. Thank you so much for joining us. Asia, thank you so much for joining us this evening. Greatly appreciate it. Right. The third question, see if I can launch this, is what is your primary occupation? So much of what we're going to hear today is all about the different ways that we connect with our, oh no, hold on one second. Why is this? Oh, there we go. Sorry. What is your primary occupation? So as I was saying, so much of what we're going to learn today is all about how we can lean into our, areas of fulfillment and also, either keep a full-time job or make that area of, your life, your full-time job. I know that I left the kind of the corporate archetype in 2019 and started my own company. But there's a lot of amazing ways to do this and to be able to find financial freedom. Okay. Fantastic. Two more really quick, and then we'll dive in. So what industries are here with us today? I was going to say, come on, tech. Let's see who all's there. Perfect. All right. Wonderful. We have a nice mix here today. And then the very last question is all about your functional expertise. And I love to see that this is not just finance for finance. So I love that we've got a good mix. I was just sharing before that this is one area that for me, I am really passionate about this because as a commercial individual, I wasn't always made aware of different approaches to managing my finances and mastering. And that was something that I really felt like was a huge, as I went out on my own to become an entrepreneur, I feel like I was missing a big chunk of some of the understanding that I really needed. And so I've been on my own journey of understanding this, and I'm just very passionate about this topic and excited to dive in. So I've had the great pleasure of introducing to you Bahroz Hussain. He is the head of e-commerce finance in the Americas at the Lego Group. As he has coined, he would love to be able to fully dive into teaching and educating, coaching individuals in this space. And this is something that he's incredibly passionate about. And I think that you'll see that as a part of this topic, it's something that truly on his podcast and, connecting with him, he's got a wealth of resources that truly can transform the way that you look at your life. And so I'm so excited to be able to kick it over to him, for him to be able to share more about his expertise in this space and how we can truly support the money mastery and transformation of individual approach to money.
Thank you, Stevie. So allow me to share my screen. And just confirm to me once you can see it.
Yes, looks great.
Can you see my screen? Well,
yes, looks great.
Cool. Thank you. So thank you, Stevie. And I just also want to thank the Enrichment Series, PNG Alumni Network, Hina Barwani, Ida, for reaching out to me and giving me this opportunity. This topic is very close to my heart. But before going into the topic, let me just start by introducing myself. So my name is Bahroz. I'm currently the head of e-commerce finance at Lego. You can see a lot of Lego sets I have at the back. A lot of them are exclusive sets, so they are not even available at the market. So I have a good collection there as well. I started my career with Procter & Gamble Finance, primarily in Southeast Asia. That's where I started. Then I moved to Middle East. So I did around 11 years with Procter & Gamble in finance. And then we immigrated to Canada. That's where I joined the Lego Group. And then a year back, I moved to US. So we've been moving quite a bit. Now, coming to the topic, in this webinar, what I intend to share is my learnings. Like, there is no rocket science that I have. It's just my learnings, what I've read, what I've learned and applied. And I also want to give an important disclaimer that this is not a financial advice. This is rather a life advice that I have, or the collection of learnings that I have are like life advice or life learnings. All these rules made me a millionaire very early, or call it early in my 30s. And I still believe I was late. If I knew or if I had learned about them earlier, I could have achieved a certain goal earlier or been more financially independent earlier than I am now. And my realization to the importance of this topic really grew multiple folds when I moved to North America. Because one of my top shocks or surprise was to be bombarded with the amount of advertisements on debt management. Like I was surprised when I would just be around or go on the web or on the TV channels, and I would see these advertisements coming in saying, call us and we'll manage your debt. And that kind of really threw me off, which was like, I've moved to the developed part of the world, and most of the people here just don't understand that, for instance, just as an example, if they're earning 100, they just need to spend 80. And I realized there is a big market for such individuals. And hence I started to learn and read more about it. And I've obviously stumbled on some obvious facts and some not so obvious ones. And that's where I built my knowledge from. I teach primarily through my YouTube channel and LinkedIn account. And so throughout this webinar, I may be sharing some references to my YouTube channel in case there is a topic I can't dive deeper into just because of time restriction. So let's get rolling. Let's get rolling into the topic. Now, one thing that I want to call out, this is not about retirement. And I just don't like the word retirement, because retirement kind of sounds as if it's something when you get old or when you stop working at all. And here my intention is not to stop working, by the way. The intention is to be financially free, because money's greatest intrinsic value is to be able to own your time. People fancy, it seems, and people at times, they fancy travel, buying stuff, but what they essentially need, or what brings the most amount of happiness, is owning your own time. So if you buy something, you'll be happy for a while, and then you're not happy anymore because you're on a hedonic treadmill. Experience is still better than buying stuff, but still it kind of tapers off as well. But owning your time is one of the best things, or things that will just brings universal happiness. Like everyone would agree that owning your time is one thing which will just bring happiness for good. Now, this flexibility is essential for two main reasons. Having to own one's time is, first, the more flexible you are, the more options you have, and the more economic opportunities you have access to. For example, you can afford to take time off and develop a new skill, or more importantly, do what you love. And for instance, I want to be a teacher, and this is what we were chatting before the webinar started, is if I can be financially free, I would just want to be a teacher. I would just go in a school and teach, or maybe in a college, I would just teach. So if I have that financial freedom, it will allow me to do exactly what I love. And by the way, I had opportunity to teach at Procter & Gamble or at Lego as well, but that's very small part of my overall life at 9 to 5 career. As I can coach people and stuff. But what I want to do is I want to do it for all of my time during the day. Second, the more flexible you are, the more of a safety net you have to endure the unexpected. For example, if you lose your job, you can take your time off. You're between jobs. So all of this, again, if you have financial freedom, you can achieve all of this. Now, before we dive into what are the levers that we can play with in order to achieve financial freedom, very important thing, and the most important thing, is knowing what is your goal. How much money is there that you need in order for you to feel that you are financially free, that you really don't need to work for money anymore. You work just because you love working or love out of passion, or the passion you have for the work. And here the rule is the 4% rule. It's a very common rule, which is all over the web. You can search it out as well. But here what I'll talk about is how I interpret the rule, or how I use it for my own sake. The rule, what it says is that you can feel, or you can be financially free once the interest or the rental income or the dividend income coming out of your investments can pay off for your expenses. So, and here the number that is being used is 4%, because it's kind of tax adjusted, inflation adjusted. It also assumes a balanced portfolio between stocks and bonds. Stocks have been seeing an historical return of around 10%. Bonds is somewhere around 3 to 4%, again, including the tax and inflation and all. So the golden number that comes out is 4%. This way, you don't really need to touch your principal. So let's say if your expenses, you feel that once you retire, your expenses would be somewhere around $40,000 annually, assuming your kids are out of your home, you paid off your house, let's say, maybe you paid off your car and stuff. So it's primarily some basic expenses that you have that you've been incurring. And for those expenses to be paid through your investments, you should have $1 million worth of investments. So 4% of $1 million will give you $40,000. So this is how you can kind of work back and first start with seeing what is the money that you need to save in order for you to feel financially secure and financially free. Now here comes the levers. There are essentially three levers. One is saving, investment, and income, and I'll talk each one of them one by one. But let me start with the most important one, which is savings. Because even if you have a very high income, if you're not saving enough, that is all just going wasted. You cannot invest if you don't save. So investment and income comes later. First, you need to fix the saving piece. And here I have some examples where we know of millionaires who used to make millions and then they went bankrupt. Because the best measure of wealth is what you have minus what you want. And by this measure, there are a lot of people who are just broke. So we'll talk about the saving first. And I want to stress more is the saving is the first and the most important piece of this entire equation. Here I have 5 heuristics or rules that I kind of learned and I applied for myself, and I'll talk about them, and I'll share them. Number one rule or the tip that I have is to track your expenses. Let's say you're starting fresh. You've never thought about financials before, and you go like, today I have set out a number for myself. Let's say I want $1 million or $2 million for myself. How do I start? The first and foremost thing that you need to do is start tracking your expenses. And this is not to control your expenses, by the way. You don't need to control them. You just need to start tracking them and track them for 6 months. Don't do more. And what I've done for myself is I've created a very simple automated method of doing this where I spend most of my spending through credit card. And the reason I do it is so I can track it. I don't do it on cash because it's difficult to track cash. At month end, I'll just copy paste everything I have in my credit card report, put it in an Excel model that I've created for myself. By the way, I have a video on my channel as well where I share how I've created that model and that simple and automated model. It just takes me like 10 minutes a month. I copy paste everything from my credit card statement, put it in my tracking report, and it kind of summarizes where I'm spending in regards to my health, my fitness, fuel, car, and stuff like that. So my advice is just do it for 6 months and see where you are spending. Don't try to control it. Don't try to optimize anything. Just track it for 6 months. What I realized when I did it for the first time, I was spending very different from what I would claim to spend or claim to my values to be. So for instance, I talk about my values to be first fitness, focus more and more on fitness. Second is family. And third is freedom, which is the saving part and all. And I realized that most of my spending was going into car and fuel and grocery, which kind of had nothing to do with my fitness and the family. And by more, I mean, it's like there is a certain basic amount of spending that you'll have to do in grocery and car, but it was really excessive. And on the fitness piece, on the family piece, I wasn't spending enough. And I was like, okay, my values are very different from the way I'm spending. So first and foremost, track. Second, once you've tracked it, you know where you're spending, you have to budget. And again, this is where your values come in. So you put your values next to the tracking and you say, okay, now I need to create a budget. Here, the tip is the 50-30-20 rule. First and foremost, very important that you start with saving 20% of your income. If you're earning 100, you're actually not earning 100. You're earning 80. The 20 you should not even assume as part of your income. It just goes in saving. And this is, by the way, just as you're starting, 20% you have to save and keep on the side. 30% you keep for your wants, which is like shopping, entertainment, and 50% is for needs, which is rental, grocery, and maybe car and all. So once you've started the tracking, now you create a budget so you know exactly how in future you should be spending or tracking against that particular budget. And again, this budgeting should be based on your values as well. So for me, fitness is important, family is important. So I'll try to make sure that after removing the 20% of savings, most of my allocation go towards fitness and family. Here, I'll just give one example. This is how I worked with my spouse, my wife. So we would always have this discussion on where to spend, where to save and all, and we would have some conflict as well there. And what I did was, both of us, we just sat together and we said, let's make a list of things, like 10 things that will represent our rich life. Because when I talk about financial freedom and budgeting and tracking, and people go like, "Oh, you're really killing yourself. You're not enjoying life and all." And I'm like, no, I'm enjoying life. It's just that it's slightly different the way I enjoy it. So we made a list of 10 things which would represent our rich life, like things we will enjoy and all. And then what we did was we drew a line when we agreed that this is the 10 things that we collectively agree on. We drew a line after 3. And we said the top 3 are the ones that we will fund like anything. This is our rich life, we'll enjoy. And all the rest, we will take it out because this is where we'll fund our rich life from. And here is one example. When we made the list, we realized we are big on travel. And we have kids as well. And when you're traveling with kids, it becomes at times very tiring as well, especially if you're taking the flight, which is more than 4 or 5 hours. And we decided that, you know what, for us, rich life is when we travel, we want to travel business class. And for us to fund that piece, there was also a car. We have 2 cars, and car was also listed down in the list. It was in towards the bottom, and we were like, okay, let's do the math. How about we just get rid of 1 car and be just a 1-car family? And there are times 1 or twice a month where we have a conflict, so we end up doing Uber. But I realized we were able to save a lot from just getting rid of 1 car, and now we can just enjoy and with regards to going on business class whenever we travel. Every time the travel is like more than 4 hours, we take a business class, which is phenomenal for us because car was never our rich life. It was just another car standing outside just out of convenience. So what I want to make here as a point is that you don't really need to kill yourself. You just need to realize what are the things which are important to you, which brings you maximum happiness, and focus on that. Let me move further to tip number 3. And here it's very simple, which is we all get employer contribution. In P&G, it used to be ISOP, and I'm sure in the other companies that you work for, whoever are still working for other companies or have jobs, you get employer contribution. Maximize it. So if your employer is contributing 6%, and they will only contribute 6% if you contribute 6% into your 401ks, Roths, if it's Canada, if it will be RRSP, DCPP, TFSC, and all, just maximize it. This is free money. They're offering you free money just for you by you contributing within your own pocket. So you take from one pocket 6%, put it in your own pocket, and someone will give you extra 6% or whatever that percentage is. Make sure you maximize it. This is like a no miss. Tip number 4 is around lifestyle inflation. Again, this is something I've used as well for myself. Every time you get an increment, if it's a 2-3% increment just to cover for the inflation, don't worry, just spend it because your cost of living is going up because of inflation, so you need that money. But whenever you have a significant increase in your increment, and this primarily happens when you get promotion or when you get when you change jobs, save that. Save that because you were used to a certain lifestyle with the salary that you were earning, and suddenly you start getting more salary. Trust me, by getting another 10-20% increase in your salary jump, it won't change your life. Like it won't change your happiness. You won't start becoming more happy by spending another 10-20%. It won't happen. But you will certainly become more happy by saving that money and being able to own your time later in the future. So make sure whenever you get a huge jump, you don't inflate your lifestyle. Rather, you keep your lifestyle intact and save that money. Because the number that I shared in the beginning, which was 20% that you need to save, that is only when you start. As you start to grow in your career, that number needs to go up from 20 to 25, 25 to 30, and so on and so forth. My rule is that I've applied for myself and I try to apply is every year or every 2 years, you should try to increase it by 1 or 2 percentage points. 1 percentage points every year, or maybe every 2 years, 1 percentage point, and keep taking it up. And lastly, is kind of something similar, which is any tailwinds you get, any surprises that you surprise money that you get could be inheritance or could be a bonus or anything which you were not looking forward for before, or wasn't part of your financials or a set of expenses. Just save that. That is not the money you should spend. I would go as a family for a dinner, have spend a few bucks out of it, very little, like a percentage or 2%, but that's it. That is just sort of celebrating it. Again, the idea is not to kill yourself, but you should save it. And again, I'm saying all this because, as I said in the beginning, and that's why I wanted to make that point, that you will realize that happiness in the long term is about owning your time versus owning that car or owning another another thing that you want to buy or a vacation or and all. So you need to keep increasing your saving rate. We've talked about saving. The second lever that I want to talk about is investing. Now, once you have a solid saving mechanism, you need to use that money to invest. So here I have like 6 tips for myself that I just want to call out and talk. Tip number 1 is compounding. And I think it's Albert Einstein who said it's the eighth wonder of the world. And if you understand it, you'll be a winner. If you don't, you'll end up paying it. And I have here one example. So imagine someone offers you to take $1 million today, or you get paid 1 penny every day, which doubles every day up to 31 days. Intuitively, you may seem to say, okay, I'll just take $1 million today. Why would I take a penny every day, which even doubles every day? The issue is that we as human beings, we can do the math of 1 + 1 is 2. But we cannot do mental math for exponential numbers. When 1 becomes 2, 2 becomes 4, 4 becomes 8, 8 becomes, and so on and so forth, it keeps on doubling. That is a math which is very difficult for us to do. One and second reason is it really pays off at the later part of the investment. So here, for instance, in this example, if you see up to day 28, you're still better off taking the million. You rather take the million if you want to quit it on day 28. But as of day 29, 30, and 31, there is an exponential increase that happens in your money. And this is compounding. This is what happens when you invest $100, you earn 10% interest on it. So you earn $10 on top of it. Now, you can choose to spend that extra $10 and next year spend again invest again $100 and earn interest on it. But compounding happens when you invest the interest that you earned on your first investment back into the investment pool next year. So I have 100, I earn 10% interest, $10 extra. Now I have $110. So I invest that $110 again next year, and I earn 10% on it, which will become $11. So I will have $121, and I invest it back. Over a period of time, the compounding piece, the interest piece, becomes so big that it kind of outruns the initial investment you did, and it will become bigger than that. And this is the power of compounding, that it beats in money that you are just investing. So if I was just investing $100 every month, that won't really make me rich or reach my financial freedom, except it only happens when you start to compound. And that's the magic of compounding. Just talking about the timing piece, which is, again, when you're young, you don't really see it, right? You're young, you go like, okay, I'll become what? I'll have this money when I'll be in my 30s, 35s, 40s. And you don't see the power of compounding every day because it's very slow. It takes time, but it just jumps up once it reaches a certain critical point. And here's one example where Warren Buffett, his net worth is $84.5 billion roughly today. And of that, $84.2 billion was accumulated after his 50th birthday because of compounding. So most of his wealth came after he turned 50. This is one. Second is Warren Buffett's average returns that he's earned on his income is around 22%, which is pretty good than average investor like me or most of the investors out there. But there are better investors than him. There are investors who earn like 40% return annually. But the benefit Warren Buffett has, which other investors who earned more return than him, is he started when he was 11 years old. And he started when he was 11 years old, and he has the benefit of time. While there are people who started very late, even they are earning higher returns, since they started late, they don't have the benefit of time. And I'll give an example what I mean by the benefit of time. Here I have a hypothetical example. There is Mr. Ben. He starts investing at age of 21. He invests $2,400 every year. And he starts contributing money at age 30. He stops contributing money at age 30. So he starts at 21, he stops at 30, and he contributes $2,400 every year. So his total investment is $21,600. Joey, on the other hand, is young. He's like, oh, no, I don't want to save early. I'd rather enjoy my life till my 30s. And after 30s, when I'll start earning more, I'll start saving more. And that's when I'll start to save. So he doesn't use the power of time. And this is what I tell young people, that what you have, like they would at times connect with me and we'll talk about how different people are earning different. And they will go like, okay, the kind of money you are earning, you can save, you can talk about financial freedom, but I'm not earning enough. And I tell them, no, you're earning less, but you still have power of time with you, which I don't have. I don't have time. And here is Joey, which is again, he says, I start at 30. I invest only 2,400 every year, which is fine, which is what Ben did as well. But he contributes until age 67. So a total of 37 years. So Ben contributed only 10 years and he contributed a total of 37 years. So in total, Joey contributed $88,000. And Joey could be me, who's talking to this young chap and he's saying, I didn't invest up till my 30 years. And now I'm investing. What happens is in the long run, at the age of 67, Ben's investment grew to become $2.1 million. Even though Ben stopped investing after age 30, he just invested for 10 years, invested in total $21,000. While Joey had to invest $88,000 and he only was able to amass $1.2 million at age 67. Why? Because while Joey had money, he didn't have time. While Ben invested less money, or let's say he had less money, he had time. So make use of time. This is the magic way of compounding. Now, another pro tip I have is, and again, I've learned it through mistakes that I've done, and which is always index when you're investing in the stock market. By the way, stock market is one of the best ways to achieve financial freedom, where you invest in a business. So you don't really, you're the owner of the business, but you're not the manager of the business. You own part of the business and you invest in the stocks. And that's one of the best and easiest way to achieve financial freedom. So when you're investing in the stock market, invest using index funds or ETFs. And the idea indexing is, for instance, you don't pick a stock. Instead of picking a single stock like GM, Tesla, Apple, P&G, whatever, you rather index. You go and buy an index ETF for, let's say, S&P. S&P 500 has been growing 10-11% for past 20 years, which is like doubling your money every 7-8 years, which is pretty good kind of investment, at least for an average investor. The risk with individual stock picking is that when the market was going up before the COVID crisis, every stock I would pick would just go up because everything was going up. And I felt so lucky and so smart. I was like, okay, I'm smart. I know how to pick stocks. And then suddenly COVID happened and the market decline happened and the inflation and the soft recession, whatever. And suddenly when the stock started to go down, that is where I realized that my investments were not good because most of the investments that I did in single stock picking went down more than the average market. So I was only lucky or I was only smart because everything was doing well. You only can tell if you're lucky or smart if when things start to go down. And I realized I don't know how to stock pick. And the reason is if you really want to stock pick, you should be into the annual report. You should be reading every word on the annual report of that company you're picking the stock. You should know their board. You should know their management. You should know their future plans. These guys like Warren Buffett and all the investors, Ray Dalio and all, they are in there, they're talking to them daily. They're in their offices. They're sitting with them. They're reading their plans. And only then they go and invest. And for someone like me who has a day job, who has family, who's focused on fitness, has a YouTube channel on the side, other hobbies as well, for me, I don't have time even to see the latest results of that company. And if that's the case, which is the case for most 99% of the investors, including myself, just invest and do an index. Another tip is don't invest in something you don't understand. And here, one example I have is crypto. I understand the concept of crypto like blockchain, but I don't understand crypto as a value. Now, many people will differ with me. It's a kind of emotional topic as well for a few, but this is where I stand. So I would recommend not to go into something you don't understand. Another piece is how to invest, which is how to time the market. How you time the market is not to time the market. It's not about the timing the market, it's time in the market. Because you will never be able to time the market, and I have an example to explain why. But how do you invest in the market is you just buy every day, every week, you buy certain stocks, make certain investments. There will be days where you will be buying cheap. There will be days when you'll be buying high. But on average, your investments will keep growing because assuming you invest in S&P 500 index, which has been growing 10 to 11% every year. So there might be days when you are like negative 15. There might be days when you're positive 15 or positive 20. But on average, you will be positive 10 in the long run. So just invest small amounts every day. Again, don't try to time the market. And here I have the example of the financial crisis. So here's a hypothetical example where, let's say you invest for 5 years in 60 equal installments, which is daily cost averaging, which is every month you invest a small portion of whatever your investment size is. This is the first row here on the chart. And you do it for 5 years, starting beginning of 2007 Jan, and 2007 when the financial crisis started. So that's where we take the example from. After 5 years, your capital would have grown 3.6 times. So whatever you invested in those small chunks every month, you will get 3.6 times back. The risk at any given the highest risk that you would see of your investment at any given point in time, which would be somewhere around when the market really bottomed in 2009, would be 17.7%. Like this would be the time when your total investment that you've done will be down 17.7%. If you're ready to wave off that shock and say, okay, I'll still keep investing month on month, at the end of the 5 years, your investment would have grown 3.6 times. The second idea is, let's say you invest your entire amount in one go. You say, no, I won't do daily cost averaging. I will invest the entire amount on Jan 1, 2007. In that case, your capital will grow 3 times, which is still good. But the drawdown risk is 48.6%. Imagine if you really needed money in 2009 and you had to take all that money out, you will be losing 50% of the value. The third is you invest your entire amount exactly on the day the market bottomed with the financial crisis. That is the bottom. If that's the bottom, there is no drawdown risk because after that, the market just kept going up. So your capital gain would be 5.8 times, and there is no drawdown risk. And the last example I have here is pre-financial crisis, just day before the market started to go down, you invest your entire amount on that day. Obviously, you'll have a bigger drawdown risk. What I'm trying to say here is you won't be able to time the market. You won't be able to know that 31st of March 2009 is the bottom of the market. So this 5.8 is out of the window. If you take the 5.8 out, which is the best number here on the chart, the next best number is daily cost averaging. So you're better off doing daily cost averaging versus trying to time the market as the other two are, which is investing entire pre-global crisis and investing entirely on the first month of 2007. So again, if you don't have that ability where you can play God in terms of timing the market, just go with daily cost averaging. Now, another pro tip that I have is with regards to cost of investment. So there are mutual funds which will, and by the way, mutual funds, most of the mutual funds, I think I had the number in the previous chart, 84% or 85% of the mutual funds underperform their benchmark in the long run. So while mutual funds may seem good and attractive way of investing, I still recommend going with a simple low-cost ETF because mutual funds are expensive. They're usually 1 to 2% fee that they charge. And here's the example. The blue line is the S&P 500 line. So if you invested in S&P 500 without any cost, like you just invest and you incur no cost, you are on the blue line. If you incur a small fee, which usually may be the case with ETFs, here the example is VFINX, which is a Vanguard 500 index fund. The fee is 0.18%. By the way, you can find even fees which is lower than this. And Vanguard is the best one because Vanguard is kind of their non-for-profit, so their fees are the cheapest possibly. So if you invest in that with incurring 0.18% every year, your investment will be 97% of the investment if you incur no fee. So very minimal cost you will incur. However, if you invested in a fund or mutual fund where you were paying 1% fee, then at the end of your investment cycle, which I have here, like around 30 years, your gain would be 23% lower than what it could have been if you invested in the low-cost index fund. So if I was investing in low-cost index fund, I would be 23% wealthier than someone not investing or investing with a mutual fund, which is charging 1%. So again, go for very low-cost index funds. And again, as I said already, there isn't many mutual funds who can really beat the market. And again, it would be just like picking one particular mutual fund out of the many, which, as I said, most of them underperform in the long run. So if all of them are underperforming in the long run, why pay so high fees? Rather just invest through ETF. Another pro tip with regards to investments I have is a question that usually pops up between tax-free versus tax-deferred. This is option I saw and I realized when I moved to Canada, and then it's in US as well between 401k and Roth, and in Canada it was TFSA and RRSPs. Here, the simple rule is, again, because of the benefit of compounding, when you invest in a tax-free account where you don't incur any tax. So invest in an account, it's an account where when you invest, you don't pay any tax on the interest or the dividend that you earn. So you are much better off investing in a tax-free account because you don't pay any tax on the capital gain or the dividend income that is there in the account, as against tax deferred. Tax deferred is when you invest your particular amount, your amount today, you don't pay tax on it. Rather, you pay tax when you withdraw it. And here, usually the idea is when you're investing in it, you're paying higher tax. When you're withdrawing, it's your retirement years, you're paying lower tax. So the tax-free will always outperform tax deferred, because in tax deferred, you'll still end up paying tax on the capital gains or on the dividend income and all that will be generated in that account, which, if you recall, I said, will eventually become the bigger portion of your investment because it will continue to compound. So you'll end up paying tax on that bigger portion of your investment, while that won't be the case for tax-free, because in tax-free, that all income is just tax-free. You don't pay anything on the compounding element of it. And here's one example I have is you invest like $6,000 per year for 25 years. Hypothetical return is 12%. The year you are investing is 30% tax rate. And the years when you're withdrawing is 20% tax rate. And here, the tax-free income will outrun the tax deferred. Now, this calculation doesn't assume this, because every time you make an investment in the tax deferred account, you save some money there and then because you don't pay tax on it, which you can also invest and earn back. However, if I even include that income, still you're better off being tax-free, unless or until you really think your tax rate will go down dramatically in the years of your retirement. Then yes, maybe tax deferred would be a good one. And hence, for this, one rule of thumb that is recommended or that I advise people is, when you're young, when you don't have high income, you invest in tax-free. The years of your life when you think you're earning the most or the maximum, probably it would be 5 to 8 years when you're on the high of your income. That is when you invest in tax deferred. So you invest in tax deferred. And when the income starts to taper down again, as you're reaching your retirement years, then you start to invest in tax-free again. Another, or the last tip I have on investing, and this is a debate and people are very emotional about this as well, and even on this webinar, there might be people who would just simply differ with me, is between stocks and property. I am a stocks person ahead of property. I have investments in property as well, but my preference is stock. And the reason I say this is because property is, there are two reasons. One is, a good investment in property is like picking a good stock, which, as I said already, is very difficult to pick. It's very difficult to pick one good stock. You can pick an index. So when I invest in stocks, I invest in the market. So I have trust that the market will go up, like the US market or the global market will continue to rise. What I cannot say for sure is, I have less surety or far less surety is whether Apple will continue to grow next 20 years, 30 years, but overall stock market will continue to grow. Similarly, going for property is like picking one stock, picking one property in your neighborhood and buying it or wherever you invest in. So that is one risk, which I see it's for me, it's just like picking a stock. If it does well, it can do well. If it no, then it is high risk. The other piece is the cost. There are so many costs and hidden costs, by the way, which are associated with investing in property that you may not even see or realize. The realtor fee, the taxes, insurance, all of this just doesn't exist in the stock market. And one more data I was reading, just on average, let's say stock market, S&P 500 has performed 10% year on year. US property market has performed somewhere or gained somewhere around 4 to 5% year on year, which is far less than the stock market gains. Again, you can argue, no, but the property I bought really did better. Fine, but that was just like picking one stock. One can also argue, if I pick a single stock, let's say Apple or Tesla or Microsoft, whichever did phenomenally good, you can also have the same argument. But if you take out the element of stock picking or lucky and just go with the market average, stocks are better than investing in property. And again, as I said, I have investments in property as well, in stocks as well, but I prefer stocks. Cool. So I've talked about savings, I've talked about investments, and here's the last lever, which is income. So you have your strong savings, then you start investing those savings, invest in a way which is low cost and compound. But then you also need to look into ways to increase your income. And you cannot get rich or get financially free by renting your time. That will never happen. So that is out of the question. Now, what I do, and these are all just food for thought. This is what I've done for myself, and you'll find people having different ideas, different expertise. Someone wants to open a shop, a bakery, a restaurant, whatever. But you need to think of it from two angles. One is leverage, one is compounding. What is leverage? Leverage is like having labor, so someone to work for you. And that's how you you hire labor, you make them work for you. This was kind of the industrial age. This could be opening a restaurant. So you open a restaurant, you still don't own your time because you're still stuck to the restaurant, but then you hire labor and then you start to own your time. The other form of leverage is money. So if you have a lot of money, you invest money and you earn money on the money. This is kind of the Warren Buffett way of investing. The third piece, which is the recent economy, is investing in products or using the leverage from products which don't have any marginal cost of reapplication. Let's say writing a book, making a YouTube video. I make one YouTube video or I make 2 a week. And once I've made it, it is on my channel. It keeps getting views. It keeps growing. It keeps earning me income. Similarly with the book, let's say you write a book. Once you've written it, as people continue to buy forever, it replicates. Does it incur any cost? I don't have to incur more cost in making that or pushing that video further. And it just gives me the income. So think of leverage, how you can create leverage, code, through media, through books. The other piece is compounding, which is compounding also comes here because overnight success is like 10 years in the making. It won't happen today. So when I started my YouTube channel, I said, I need to make 100 videos before I can even think of monetizing. And 100 videos took me 2 years. And I didn't monetize for the first 2 years. And this is what I tell everyone as well, that you have to be in the long game, in the long run. You can't just look for instant gratification and say, okay, I'll invest here, I'll start this business and it will go up. Now, there are people who've done it. We all know the success stories, but then we only read about those success stories. And even those success stories are like 10 years in the making because there was a lot of groundwork that happened before that, which we don't see. So give yourself time. And here, one tip I have is think of something that you think you can retire into. So for me, it is teaching. And I was like, okay, how can I build their teaching capability in myself? So by the time I retire I'm ready to be a teacher. By the time, again, I'm using the word retirement, but by the time I'm financially free, I'm ready to be that teacher. And I was like, how about I start doing it with YouTube and start teaching people with YouTube? So I do 2 videos a week, and then I have some coaching sessions, which I started to do 6 months ago. And then it's kind of compounding, it's building up. So it's very slow. And I want to keep it slow because I have a day job as well. I can't just go all in. But over a period of time, 1 year, 2 year, 3 year, 4 year, 5 year, 10 years time, 15 years time, it will become something where I can say, okay, now I'm kind of ready. I'm financially free. And this is what I'm passionate about. This is what I love. And I will just continue to focus on that. So keep it on the side, keep it a side burner, and keep it small. Now, a couple of food for thoughts that I have is what comes easy for you that is hard for others. Think of something that comes very naturally easy for you. For me, it was like when I was considered one of the good coaches in the places I worked. And I realized this is something which comes very naturally to me. I enjoy it. And I found that it is not very easy, or not everyone enjoys it that much. So that's the thing I started. When I started my YouTube channel, I started teaching. Find what you're good at and teach others. Again, similar to what previously said, which is I like teaching. So I started doing, or coaching, I started doing that on the YouTube channel. Get other people to pay you to become wealthy. Help other people to succeed. Now, this is, again, this is the part of the teaching as well, which is if you know something already, you know how to win in a corporate culture, you know how to do e-commerce, you know how to do digital marketing, you know how to do financials. Just start teaching others and help them be successful. So what I do on my YouTube channel is I coach others to become successful in their corporate careers with their interview skills, with their job hunting skills, and personal finance as well. So I kind of cover personal finance, and career success for early and mid-career professionals on my channel. Another piece, and this is actually how I started my YouTube channel, was when a friend calls you for an advice. For instance, they just randomly call you and they go like, I want to buy a new car. Can you give me some advice? Can you give me some ideas? And that is something which you realize that there is someone in the world who doesn't know about it, and you are one person who knows about it, and this other person thinks you know about it, and hence they're reaching out to you. So a friend of mine, actually, when I moved to Canada, they reached out to me saying they want to move to Canada as well, and they need help with regards to how to find a job and how to settle in Canada. And I was like, I had a long session with them and I explained them, and then I was like, okay, this is something I know, this person doesn't know. If I put it on a YouTube channel, if I leverage it, I will be able to reach more people. So that's what I did. And last but not the least is find 1,000 true fans. This is a blog by Kevin Kelly, one of my favorite writers. I highly recommend checking out his books as well. And he wrote a blog of 1,000 true fans. If you can find like 1,000 true fans who can pay you $100 a year, you have like $100,000. The idea is like they're really your true fans. If you write a book, if you write a blog, if you make a video, they'll check it out. If you sell merchandise, they'll buy your merchandise, whatever. And if you can just find those 1,000 true fans. So the idea is that you really don't need to go big. You don't really need to start a big trading company. You can if that's your passion, but you can start very small as well. And that's the point I want to make here, which is how you can start small, use the leverage, use compounding, and then make it big in a couple of years, so that you can eventually retire into it. Just this last slide before we can move into questions and answers, if there are any, is there are 3 levers: savings, start with tracking, then budget, and avoid lifestyle inflation. If you can do these 3 things, you're good. Investments is start early. As I said, power of time is far more powerful than the power of money. Keep costs low and don't time the market. And keep diversifying. And hence, stock market is the best way to diversify. By the way, one thing I should have mentioned in the stock versus property, the one benefit that the property has over the stocks is you can get leverage, easy leverage on property as against stocks. Like you can always mortgage your house. So if it's a $1 million house, you only pay $200,000 as, let's say, 20% as an equity, and you still buy a house. And when the house sells for $1.2 million, you've kind of made $400,000 on an investment of $200,000. So you leveraged, which is easy to get on a property than on stocks. But I am not a huge fan of leverage, and especially as you start to age, you should get rid of leverage as much as possible you can, because it's pretty risky. You can still take leverage in stocks, but I think the stocks leverage would be slightly more difficult to get and it's more expensive. And one more thing on property is, while you get the leverage, you won't get it for every property. You may get it for one property, but when you go and get a mortgage, second mortgage, you won't be able to get the same size of mortgage and so on and so forth. And especially in days like today, where the interest rates are like skyrocketing, it's not a great idea unless you really have a gold mine somewhere, a property that you found. It's not the best of the ideas. Anyway, just moving to the last pillar, which is income. Think of leverage and think of compounding. So that's all I had to share, and I'll probably stop sharing, and Stevie, I will pass it on to you.
Oh my gosh. Well, thank you so much. I know that this is, a lot of foundational in combination with a lot of really fantastic insight and just, thinking about things a little bit differently. I ask that if you do have any questions, please place them into the Q&A section. We do have one here. So such a great session. So for those of us who are moving into our later years, who have saved but still earning, what's our best strategy? So I think you touched on this a little bit, but if you maybe want to pull out a few of the key insights to make sure we really hit it home.
Yeah, so one thing is as you start to age, you also need to start balancing your portfolio. When I was young, it was easy for me to invest everything in equities and earn like 10, 12%, 11%, assuming S&P 500 returns. But as you start to age, you need to start to balance out that, because I also say that success at the end of the day is having a good night's sleep. So if you are, let's say, in your 50s and you are invested highly in equities, and suddenly market drops by, let's say it's COVID, and market drops by 20-25%, I would have sleepless nights. Even though I know everything goes up, market goes up again, it will be fine. It has always been fine. Market keeps going up. but I won't be able to sleep. And having that sleep is far more important than getting rich quick. So I would say start balancing your portfolio as you start to grow older, because the size of your portfolio starts to grow as well. And then you have less runway or less time for you to really take a risk. Because if something goes down now, I know I have another 5 years, I'm still working, I can pick it up. But the older you get, you won't have that runway anymore where you can pick it up.
I think that's fantastic. I know that I have one quick question for you that came out of today. I know that you started talking about, investing early for children and really allowing for us to be able to, put money potentially in the market even for them. So question for you is, we've got, I've got money put into a 529 for my son, and I'm thinking through different approaches. If you could just touch on a few of the highlights again for us on those of us that have young children and how to make sure that we're setting them up for success. So maybe they can also, by the time that they're in their 30s, maybe be millionaires.
Yeah, so great question. Again, I'm new to US, so I'm still learning my ways into different accounts. But I can speak how I managed in Canada, and we had a similar kind of a saving account for kids, where you invest and the government contributes on top. That is another investment. Rather, if I had to rank the investments, if it was Canada, I would rank it the highest, because you get the most amount of returns in that. If you invest, it's like if you invest $2,000 in your kid's education plan, the government pays another $500. Yep. Which is a huge 25% return that you get on your investment. So do that if you've decided, and if you're serious about that you have to pay for your kids' education, then make sure you start with that investment first, because it pays the highest returns. Second is make sure you teach your kids as well the power of compounding. As I said, Warren Buffett started when he was 11 years old. If your kids can start when they're 11 years old, just out of saving, like you give them 25%, $25 pocket money, they can save $5 and just compound it. Do the math, and obviously they won't be getting $25 every for the rest of their life. But just do the math. They start early, they develop that concept, and let that money compound for them. Let it grow for them, and teach them the power of compounding. Allow them to see the benefit of time, and yeah, let them save first before you save for them.
I think that is absolutely fantastic. And I really appreciate you taking the time today. I know I have so many more questions, but I will be going to your YouTube channel and checking that out before I reach out to you and ask any questions. If you wouldn't mind just going ahead and placing any of the links that you want to share into the chat, that would be great. For those of you, just as we kind of wrap up on here, if you would please complete the survey that's in the chat, I would greatly appreciate it. You will also be receiving an email with the same survey to make sure that we are getting the most out of your feedback and understanding how we can best serve you from an enrichment series. I would also encourage you that if you have any opportunity to join us at the global conference this November, I would highly encourage it. It's going to be incredible. We have so many, power-packed panels and agenda items that are coming. We have 4 Emeritus P&G CEOs, 7 P&G company leaders, 40 plus alumni thought leaders, and including Google, Publicis, Logitech, Egon Zehnder, T-Mobile, Kinsa, the Defensive Line and B-Lab, as well as Global Citizen and Howard University, Chadwick Boseman College of Fine Arts. So many amazing opportunities for you to connect and engage with us. I'm so grateful. Thank you so much for your time today. And I am, eternally grateful for all of you for spending the last hour with us. I hope you have a wonderful rest of your day, and we look forward to seeing you at next month's with Sophie Bloom. Thank you.
Thank you, guys. Thank you, everyone. Thank you, Stevie.